Welcome, everyone. We are pleased that you have joined us for today's webinar titled A Unique Indirect Section 1035 Exchange. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Jennifer Lawler. Jennifer joined the advanced underwriting team in October 2014. Before joining the team, she spent 6 years working for a tax and estate planning group. While there, she worked extensively on tax return prep, estate planning, and assisting clients with their tax needs. Jennifer will draw on her legal, tax, and life insurance background and practical experience for today's webinar. And here she is.
Thanks, Amber, and thanks for joining us for today's webinar, an unusual Section 1035 exchange rule. We're glad to have you here. But before we get into today's material, I'm going to take a moment to remind everyone to join us for July's webinar on July 3rd, where we'll discuss the Transfer for Value Rule Revisited. As a reminder, we conduct these webinars for free for financial professionals on the first Wednesday of every month at 11 a.m. Central. We also post our webinars on our YouTube channel, so if you can't join us, you can find a recording of this webinar and all of our webinars on our YouTube channel. And now for the interactive part of today's webinar. We're going to vote on what topic everyone is interested in to hear more about in August. The options for the August webinar are trust as a beneficiary of an annuity, a fresh look at QCDs, or fighting with the IRS. I'll go ahead and launch the poll and give everyone a minute or two to vote. All right, give everybody a few more seconds. Anybody that's not voted, go ahead and do so now. All right, it looks like the August webinar will cover trust as a beneficiary of an annuity. Thank you for participating in that, and I hope you can join us for that. Section 1035 of the IRC is one of the most important and useful sections of the code for life insurance professionals. If followed properly, it allows the taxpayer to avoid recognition of any taxable gain on the disposition of an existing life policy or annuity. In other words, it allows a client to trade one insurance policy or annuity for another without an immediate income tax result in most cases. This can be a very valuable tool when used correctly. We will not be discussing all of the issues that might arise during a Section 1035 exchange, such as taxable boot or other potential pitfalls. Those are a topic for another day, but just know that these exchanges can get complicated if the rules are not followed. Today we will be talking about a very unique exception to the normal rules and when it might apply. So when do we typically use the Section 1035 exchange? The Section 1035 exchange might be a good option for a client under several circumstances. The client may have shifting needs, and a new policy or contract might provide better options for performance than an existing one. A new policy might be better suited to the client's investment philosophy or insurance needs than the old one. The cost to maintain a new policy may be lower than the existing policy. An exchange might also be appropriate where the client no longer needs a life policy but wants to trade it in for an annuity. And as we'll learn today, it also might be a 1035 exchange might also be a valuable tool if a company is in financial jeopardy. And as you can see, there are a lot of instances where a 1035 exchange is useful. But there are a lot of things to know about facilitating these types of exchanges. To begin with, we'll talk about what Section 1035 actually says. Section 1035 of the Code can seem deceptively simple. Here's the Code section. It says that no gain or loss shall be recognized on the exchange of a life policy for a new life policy or an endowment contract, or an annuity or a qualified long-term care contract. It also says that a contract of endowment can be exchanged for another contract of endowment, an annuity contract, or a qualified long-term care insurance contract. An annuity contract can be exchanged for another annuity contract or for a qualified long-term care contract. A qualified long-term care contract can be exchanged for another qualified long-term care contract. Again, that taken alone may seem simple, but there are a lot of rules and nuances that must be followed for the transaction to be tax-free. For instance, the parties to the contract have to be the same before and after the exchange. The new contract must have the same owner as well as annuitant or insured as the old contract. The exchange might also be denied for other technical reasons as well, and both companies have to work together to make sure that the exchange goes smoothly. Another key requirement for nearly all successful Section 1035 exchanges is that the funds must be transferred directly from the old policy to the new policy. If two companies are involved, the existing contract and its values have to be assigned by the old carrier in favor of the new carrier. Under normal circumstances, the rules do not allow a taxpayer to cash out the old contract and redeposit the funds into a new contract, as one taxpayer found out to her detriment. In Private Letter Ruling 2006-22020, the taxpayer received a distribution from an annuity and argued that she should be allowed to use the proceeds to purchase a new annuity within 60 days, similar to a 60-day rollover one might perform with a qualified annuity. She wanted to treat the transaction as a tax-free exchange under Section 1035. The IRS stressed that Section 1035 envisions an exchange of an annuity contract for another annuity contract, not a distribution from an annuity contract followed by the purchase of a new annuity contract weeks or months later. The IRS went on to say that because the taxpayer had received a distribution of the annuity, there was no longer an annuity to exchange. The IRS denied her request and the distribution was deemed taxable. This is an example of how the details really matter when it comes to Section 1035. Time and time again, the IRS has come to the same conclusion when taxpayers sought to perform an indirect exchange of a life policy or non-qualified annuity. So what is a taxpayer to do when an insurance company falls on financial hardship and becomes insolvent, leaving the taxpayer with very few options about receiving funds from their contract? Luckily, the IRS has actually addressed this situation. In 1992, the service published Revenue Procedure 92-44, which allows for an indirect exchange. The revenue procedure reads in part that it provides administrative relief for taxpayers who surrender life insurance or annuity contracts issued by financially troubled insurance companies that are subject to conservatorship, receivership, or similar state regulatory proceedings. If the requirements of the procedure are followed, a policyholder who receives cash from the surrender of a life insurance contract or an annuity contract from a company that has fallen onto financial hardships can, in fact, reinvest those proceeds in a new contract tax-free. Again, they have to strictly follow the rules that are set out in the procedure, and there are several of them. And again, like I said, there are several rules that have to be followed for this to work like it should. We've got them all on the screen, and I'm going to go over them briefly. But if you would like to receive the backup for this, you can contact us, and you can we'll send it to you, and that way you can have it in front of you because this is a lot. But the policy has to have been issued. The procedure goes on to say that the policy has to have been issued by a company subject to rehabilitation, conservatorship, insolvency, or similar proceedings at the time of the cash distribution. Again, they have to be in these proceedings at the time of the cash distribution. The taxpayer has to withdraw 100% of the distribution to which she is entitled, or if less, the maximum amount permitted to be withdrawn under the terms of the proceedings. An exchange of the affected policy or contract into the new policy or contract that the proceeds are reinvested in would have to qualify for a valid tax-free exchange under Section 1035 under normal circumstances. The funds have to be reinvested within 60 days of receipt of the cash distribution. If the cash distribution is restricted by the state proceedings to an amount that is less than the taxpayer is entitled to in full settlement of his or her rights, the taxpayer must assign all rights to any future distributions under the old policy or contract to the issuer of the new policy or contract for investment in the new policy or contract. The procedure goes on to list even more rules that should be followed. The taxpayer must transmit to the new company a statement containing the following information with respect to the transaction. They must report the gross amount of cash distributed under the affected policy or contract, the amount of the cash received under the affected policy or contract that has been reinvested in the new policy or contract, and the taxpayer's investment in the affected policy or contract on the date of the initial distribution of cash. And that's not all. When the taxpayer files their tax return for the year of the indirect exchange, they must attach the following information to their tax return: a statement that bears the legend, Election under Revenue Procedure 92-44, and it must include the name of the issuer of the new policy or contract and the policy number of the new policy or contract. They must also attach a copy of the statement that the taxpayer had to provide to the issuer of the new policy or contract. So they must also provide that statement with their tax return to get this to go through smoothly and to be a tax-free transaction. As you can tell, the situation for use of an indirect Section 1035 exchange is very limited and specific, and it requires that the taxpayer do and follow very specific rules. Section 1035 exchanges can be a great tool to help our clients. A Section 1035 exchange may be a good option for clients that are hoping to modernize their current contract or policy or to meet changing life needs, or for those that wish to implement a layered annuity strategy. An exchange might be needed to repurpose a loss in a life policy. And as we've learned today, in some situations, an exchange provides an escape from a financially troubled company. As you might imagine, this isn't an issue that comes up very often. We've got a list of some of the companies that have faced these types of hardships in recent years, and thankfully there aren't very many, but it's good to know there might be a way out if needed. Section 1035 exchanges are powerful tools for our clients, allowing them greater flexibility when it comes to planning for their future. Our clients will look to us for guidance on these issues, and we've got to ensure that they have all of the tools and options available to them. While on its face, Section 1035 can seem simple, but in practice, the professional must consider whether or not one or more complicated issues might exist. These exchanges require a lot of nuance and attention to detail to be completed properly. A well-informed professional can help their client through these situations. A life insurance company facing financial hardship is an especially scary prospect for a client. It's best practice to familiarize yourself with any possible resolution for your client and to know when one might be the right fit. An indirect Section 1035 exchange is not something we would expect to run into very often, but it's good to know when it might be an option and how to complete it. And again, if you have further questions about this or would like to receive the details, you can contact us about that, and we will get that to you. Thanks for listening in today. And with that, I will turn it back over to Amber.
Thank you for joining us today. Join us for next month's webinar on July 3rd, where we'll be discussing Transfer for Value Rule Revisited. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Check out our YouTube channel to view past webinars. And finally, for more information about the services that advanced underwriting consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.